All right. So let's just jump right into here and talk about a couple things fundamentally that are going on. First of all is the weather, right? Lots and lots of talk about weather, weather, weather. And I think the best way to think about this is what got us to where we are is demand. And then we had complications in South America, and that those complications are still kind of unpacking, right? The 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 crop in South America just keeps getting smaller and smaller and smaller, with the USDA sitting just above 100 million metric tons, and most other analysts are sitting um, much lower. So you've got somewhere between 88 and 95 million metric tons in most of the analyst world. So you've got the demand-led bull market that got us to where we are. Now you've got the weather issue in South America, and now you've got um, emerging weather issues here in the U.S., right? Um, and overnight, you're seeing moisture and rains between 3 and 6 inches across some of the Dakotas. So that's putting a little bit of pressure on the market. Maybe I'm going to show you another reason for why the market's doing what it's doing here this morning in just a second. But it could be weather, right? And so as we get into this, the next 60 days, I think our volatility is just going to be wild. I think we're going to have swings that make us uncomfortable, and I think we're going to have a lot of emotion to deal with. So one of the things that we need to keep in mind is that we didn't get here on a fluke weather event. This isn't a rally that came about just because it got hot and dry in over a couple week period, right? This is a sustained bull market that's been verified by demand, by execution of deliveries, by continually improving fundamentals across ethanol, across the feeding sector and the export sector. So you've got all of these different demand drivers that have all just uh, um, kind of coalesced all at once to get us to where we're at. And now we're debating what the yield's going to be and how many acres we're going to plant. So we've got a WASDE report tomorrow, and we've got the June 30 acreage report and stocks report on June 30, right? So two potentially large movers. So let's take them one at a time. First, let's talk about what tomorrow is going to say. I don't think it's going to be a huge deal. I think the USDA is more likely than not to actually increase usage and lower the balance sheet from $1.2 billion to maybe 950 million, maybe to $1 billion. And they're going to do that by maybe raising exports a little bit. Maybe they're going to raise ethanol usage just a little bit. Maybe they're going to raise feed usage just a little bit. Nevertheless, I think the odds of a bearish surprise on the supply side are very low. I think it's much more likely that they actually trim that balance sheet just a little bit. And then we get into the acreage report, and anybody's guess is as good as anybody else's guess what they're going to say on the acreage. Are we going to have a 4 million acre increase, 5, 10? I don't know. Clearly 10 is bearish. If you have a 2 to 3 million acre increase, then I don't think it's really that bearish. So let's look at what the technicals will say and kind of how we're setting up. So I'm going to pull up the corn chart here. First of all, this is December corn. This is where we gave our last market chat right down here. And we said then, hey, look, we're really bullish December corn and feel like it's got to go challenge the highs. And here we are. So now it's done that. Yay, great. Now what, right? Which direction do we go from here? And what are these things telling us? Well, in order to dig into that, we need to first look at where we are, right? What's our bias? Well, we're sitting above our clouds. So we're sitting above our cloud, and therefore we're bullish. And don't make it any more difficult than that. There's no other reason to be bearish if you're above this cloud. We're above where we were 26 days ago. That's bullish. You're sitting above your moving averages. That's bullish. The only thing that could be potentially negative right here is the fact that we're sitting right below the previous high and right below this dotted line, which is a kind of a forecasted point of resistance that was triggered by this 13 right here on this chart. And you can see it held, right? It held the resistance and turned right back around. So we've got that potential bearish setup. So let's look deeper into what the charts are telling us, and let's look at what the shorter time frames are saying, right? Because just what are the odds that we just turn around and implode and come back down from here, or do we push up and take out this old high? So this is the 240-minute chart of corn. And again, let's walk through our waterfall, right? Very simple, very objective. We're above our cloud. We're above where we were 26 days ago, and we're right in the sweet spot of the buy zone between the two moving averages, or the fast and slow lines. Second, our wave counts are bullish. You've got a very steep move from this low that happened down here, and we've moved straight up, and we've had very little weakness. What the market's been struggling with is this gap right here. Now, for those of you that aren't familiar with gaps happen on charts, and what it is when a bar closes and this next bar opens above or below the range of the prior bar, you leave this blank space in a chart. And what this does to the market is throws it off center. It's not orderly when you start gapping up and down, right? Markets tend to trend, but they can't stand these gaps. So there's generally three kinds of gaps. You've got a breakaway gap, which happens at the beginning or the of a trend. You have a measuring gap, which happens in the middle of a trend, and you have an exhaustion gap, which typically happens at the end of a trend. Now, in order for gaps to kind of confirm themselves, you've got to decide which one it is, and it's impossible to know on the day that they happen what it is. If this is a measuring gap, then this gap counts. Let me pull this chart back just a little bit and move to a different one, so you can see it. If this is a measuring gap right here, this is back to a daily chart of December corn. This measuring gap counts somewhere up into the 750 per bushel range if you're gonna challenge that. So if it's an exhaustion gap, then we're done and we're just gonna go back lower. That's what an exhaustion gap would mean, is, oh, we're finished. So the market's trying to resolve that. So what I think is going to happen, because you got to overlay your fundamentals and you got to overlay everything that you know, and you got to read it all in context, right? Because the market's not sending anybody memos, saying, hey, this is what I'm going to do. It's just giving us whispers of where it is setting itself up for. So if you look at this chart and you look at this gap, I think we're trying to close this gap this morning. We got real close. 92 3/4 is the top. We've traded down to 94. I would expect this to close here today. Now I'm going to jump back to the 4-hour chart so that you can listen to or so you can see what that looks like here. If we get this gap closed, right, and we can pull right in here and stay above this cloud. So 582, 581, 582 is a level at which we want to watch really closely. Holding these prior highs right here, and certainly these prior closes and opens of these bars right in here, which would be marked by the thick pieces of these candlesticks. What we want to do is see these hold and see this thing trade right down into this range right in here, and then turn higher. And I think sometimes you got to break a market to rally it. So we've pumped up against these highs twice, and we've now backed back up, and we're closing this gap. So I think this setup is really bullish to explode us up to new highs and send us higher. So let's take a look at this again on our daily chart, because I think you got to give it a lot of room. So 581 is this level right here, which is the top of this box. That's a short-term kind of target or breaking point where we really kind of want to defend it and not let it get too far away from us. But in all reality, this is the low that we want to see hold. If this low holds and remains intact, then any trade down into this region right in here is still a buying opportunity, because you've got a really nice risk reward from 560, anywhere from this 580 to 560 range. You can put a stop right down in here at 543, and you might make as much as $2 a bushel if that count is accurate and we do push higher. So a move lower isn't bearish in our view. And when you overlay that with the fundamentals, you've got dryness, you've got dry forecasts, you've got cold ocean temperatures on the West Coast, you've got the setup here for below trend line yields, and remember our balance sheet. We must have trend line yields or better in order to grow our carryout. This is a year where great yields are a must, and anything less than that is considered bullish. So if the market's job is to discount the probability of future events, then it must discount the probability of lower yields, and it's not going to resolve itself with lower prices in that context. And I think that's exactly what this is telling us to do. So we've got two entry points here, right? One is right down in here at the top of this gap with a short stop. The other one is a more patient, longer term view all the way down to below this low right in here at 558 as a buy zone. Now, if these all get broken and we can't hold these clouds, then odds are that we could come challenge this low down here and come all the way back to 499. But I really think you got to see a major shift in weather in a really bearish acreage report in order for that to happen. All right, so that's 13 minutes on the what ifs of corn. Now let's talk about what we should do to manage it. I really like the thought of just letting this trade this week, see how this develops, see if this 581 level holds, and then we could turn back around and go higher. I think we could do all of that in the next couple of days and end the week back above at new highs if we get any sort of a bullish tailwind out of this report. So I really don't like the idea of setting hedges right in here, because I think they're just too expensive, and the upward mobility is too much. Now, if we reverse this thing and come higher today, and we really push back up into new highs, then into that June 30 report, what I think you want to do is look at short dated puts to defend yourself against a knee-jerk reaction. But I don't want to do a lot of cash sales. I don't want to do anything that really binds our hands. I think we want to stay nimble, because the upward mobility of this market is really going to be powerful if we keep shrinking the crop. So I think short term 581, longer term kind of this 558 range. And if we trade down into that, then we'll have some different discussions. But I think we got to give it lots of room and be very, very patient and let this thing do what it's going to do. November beans, we broke out the new highs yesterday. We're kind of flip-flopping around the top. I think they're going to keep going higher. Beans are people have just accepted the volatility of beans. And look at July. From Sunday night's open to yesterday's close, beans traveled a gross total distance of $1.70 a bushel. Up, down, and yet here we are at the exact same level that we pretty much closed at on Friday. So we've moved $1.70 and haven't gone anywhere in beans. And I think that's the type of volatility we're going to see. And I think that's what that's a sign of is underpinning strength behind this market, that no, we're not rationing demand. No, we're not out of the woods. And yes, rain makes grain, but it darn well better, or else we have a total global food shortage that we've never dealt with before. So you've got new old crop kind of floundering and being real patient, and you've got new crop rallying out to new highs and continuing to put premium underneath it. So I think that's going to continue. I think it's going to keep working itself higher. I don't see anything on this chart that would suggest otherwise. All right, now let's look at Kansas City wheat. This has been the hardest one to trade of the whole complex, and that's because, especially for those of you that are new, Kansas City wheat has got it trades in relationship to corn. So while we have plenty of supply and the crop is going to be great, and we have all these bearish things that are going on with wheat, it really can't break a lot lower because corn is just so strong. So you've got Kansas City wheat that's trading at a discount to corn, and has been for quite some time. In fact, the relationship between the two is at an all-time. Kansas City's the cheapest it's ever been to corn in history. So it's been putting itself into the feed ration, and that extends the life of corn, right? But remember, the reason that they're feeding wheat is because they can't get the corn. It's not because it's a better feedstock, or they would prefer to do it that way. It's actually a lot of work for them to change the rations. They're just having trouble sourcing it, so they're moving to the next best available thing. And if you look at the longer term charts on wheat, they really look ballistic. Wheat is poised and set up and ready to really rocket higher, especially if corn goes. So I think if we see a move in corn, I think we're going to see wheat exceed it. So what I think what we want to do is keep our upside wide open. And I know harvest is coming, and I know it's nerve-wracking to keep your upside open and not have a lot of sales on the books. But I think this is a situation where coming into July and August, we want to keep as much wheat as we can in our own control. We want to know what we have, and we want to be aware of what our basis levels are doing, because the potential is that they could get pretty hot if it's hot and dry and corn is short. So I think patience is the tune of the month, is the tune of the spring, is the tune of the summer, and I think we just got to stick with it, because I think the fundamentals, the total circumstance, the totality of everything is that this growing season is not going to fully resolve the supply issues that we have. I think we're gonna be underpinned for a long time, and our goal is just to make good sales and try to capture some of these volatility swings without betting the farm on it as we move forward. So we'll see what the USDA does tomorrow, and if something major happens, we'll obviously update ourselves and send out a video. There's always risk in trading futures and options. If you're going to trade them, you should do so in light of your own financial condition. And you should always consult with and work with professionals before you trade. That's what I have for you this week. I hope you have a great week. It's good to be back, and we will talk to you again next Wednesday.